us guidance every meeting. I mean, it can be lesser guidance, I get that, but there's sort of a vacuum here to move on. I'm sorry, I don't have this memorized, John. I'm trying to. I took a quiz and flunked. March 22nd, May 3rd. When does this get important again? I don't have an answer.
So if we had the statement today, Tom, alongside a summary of economic projections, Dan, I think this is a question for you. Dan, if we had that SEP today, how do you think it would evolve relative to what we got in December?
I actually don't think it would change as much as people think. You know, we have those doves vote, you know, rotating in. We have a lot of people talking about maybe Shaw's index, who's a voting member of the Fed now, Lori Logan from the Dallas Fed is a voting member, Austin Goolsbee is now a voting member of the FOMC at this meeting as well, from the Chicago Fed, all new voting members, Neil Kashkari now on the other side, who used to be a dove, now very hawkish. I think it's really important to understand that the data we've just gotten in the last couple of days actually hardens the Fed's resolve. And Chairman Powell went out of his way to say that there was no one who had a rate cut priced in December in the SEP when he talked about it. Now, Chairman Powell doesn't really love the SEP. It's something that's been sort of a thorn in his side at times. But I think that was very important guidance that he gave, that no one had a rate cut for 2023. The Fed really wants to hammer that point in, and even though we have some doves on the Fed, they're going to be looking at the data that's just come in and say, you know what, we should stick to where we are. Stay the course is what we heard over and over again. This is going to be a very hawkish description of that meeting, and I don't think there's as much debate as many people thought was emerging. I think that just got quashed by the data we've seen.
Mike, your thoughts?
So I would agree. I don't think the set would have changed all that much. I think the terminal rate projection median would be about the same. Now, I'll just make a point, though, in this regard. You know, you can be hawkish in what you do. You can be hawkish in what you say. After slowing down for the second straight meeting to 25 basis points, it's going to be really hard to change the effect of that, right? So if they really, really wanted to push back against expectations of easing in financial conditions or cuts later, or just if they wanted to kind of, you know, reassert their intent, they could have gone 50 and they didn't. So there's not a lot, I think, that you can talk about at this point without another forecast, you know, with, you know, to really kind of change what markets think. Markets know you slowed down again. So, you know, it's a dovish meeting on net relative to where the committee was just a month or two ago.
If it's a dovish meeting, Michael, and it was nice of you to arrange for CPI Wednesday or whatever it is to be Valentine's Day. Did you know that, John?
I didn't know that.
CPI is Valentine's Day. Michael Gabin, what if we get a disinflationary tinged February 14th CPI day? What does that do to our world?
Well, it reinforces the view that we're past peak inflation. It probably means it's easier for the Fed to accept that inflation's moving lower. And it would reinforce the view of the minds of markets that the Fed could be cutting later this year. So the faster inflation dissipates, then the Fed's at risk of its policy rate getting too tight, right? So there's some probability that you'll get cuts later this year. So I think it would reinforce the narrative.
Dan, you have an understanding of the Midwest of this nation like really no one we speak to. And I want to go to the great Jim Glassman at JP Morgan, who is heated in his commercial banking meetings of the optimism of America. I looked at a zip code in Kansas a couple days ago on a Blackstone thing, and the unemployment rate is 2.2% in Kansas. Is the East Coast, are the elites like Lisa Abramowitz overwrought about all this while America booms?
We are.
Sorry, go ahead, Diane.
I was just going to say, on the Midwest, it's really interesting to see the job opening data today in some of the states that are seeing declines in openings, like Texas, related to the tech sector. Their job openings actually declined. Florida's still strong, but actually much of the job openings that we saw accelerate were in the Midwest, including Illinois, Wisconsin, Iowa. That's important. That's been a shift that we've seen. And talking to the automakers and OEMs, what we're hearing out there is that although they'd like to ramp up, they're worried about affordability on vehicles. And even though they'd like to ramp up as China reopens and they get more chips, they also just don't have the workers to do it, and they're going into UAW contracts in June, and they aren't wanting third shifts right now, and that's important because labor is a constraint to them. That is something we have to watch very carefully.
Dan, just quickly, we usually give you the opportunity to pose a question for Chairman Powell. Can we wrap things up by doing that? Your thoughts going into this one?
I think they need to ask them yet again, what role do financial markets play in their decision making? How do they want to push back against financial markets? And I actually disagree. I think they can go ahead and go 50 if they actually felt like the situation was deteriorating and inflation was accelerating again. This is a Fed that's shown its willingness to do a U-turn and do it aggressively. I would not underestimate their commitment to doing that again if they felt it need be.
Mike Gapen, final word. Same question to you, sir.
Listen, I'll refer back to what I said earlier. Is it on the table that balance sheet runoff can continue even if you're cutting rates? So can you mix your instruments in a different way to keep financial conditions tighter for longer?
Mike Gapen, Dan Swanton, both of you, thank you. If you are just tuning in, we are 12 minutes away from a news conference with Chairman Powell after the Fed Reserve chose to hike interest rates 25 basis points, another downshift. You're looking for some form of weight for this time. We love this phrase. Hawkish downshift.
Oh, you're killing me.
When you go from 50 to 25 and push back against market pricing for rate cuts.
Every guest that we have is different. And Diane Swart from Bank One a few years back working for Mr. Diamond when nobody knew who he was. And the bottom line is, John, there's a labor fabric here, and that is, Larry talks about the unknown unknown.
Sure.
The unknown unknown right now is the American labor economy. And it looks like to me, away from the tech, overhiring and that, it's a job-making machine. She just said that there. And the underline is Amazon and $17 an hour. That's changed the entire dialogue of labor in this country.
Totally agree. If you look into the statement this afternoon from the Federal Reserve, that line is still in there. The committee anticipates that ongoing increases in the target range will be appropriate. The market response, Lisa picked up on this, down, back up, down again. We're down 0.4% on the S&P, the Nasdaq largely unchanged. At the front end of the yield curve, the 2-year yield just a little bit higher by 3 basis points on a 2-year to 4.22. You can call it 4.23. On a 10-year, we move lower to 3.48. So the curve a little bit more inverted. Negative 74 basis points, the 2s10s curve right now. I'm pleased to say that joining us is Greg Davis, the Vanguard CIO, waiting patiently. Greg, fantastic to catch up with you, sir. It's been too long. We are about 10 minutes away from this news conference. Greg, can I just get your first thoughts on that statement from this Fed about 20 minutes ago?
That statement was in line with what we were thinking in terms of, going 25 basis points this meeting, and then the need to do ongoing increases is pretty much what our economics team is forecasting for the Fed to go to a 5.25 type rate over time.
Greg, you've got a wonderful John Bogle view on your Vanguard note that if you miss the 30 best days going back a few years to 1928, you're wiped out. You don't get to play. How do our viewers and listeners get to play given the cacophony and noise of a Fed?
It's a great question, Tom. The reality is what we say to our investors is they need to stay fully invested at all times. And the point of that note is really the fact that if you miss the 30 best days, you're ultimately going to reduce 50% of your long-term returns. And we know it's unbelievably hard for investors to time markets. So for those investors, we just tell them to focus on the things that they can control, balance, diversification, making sure they're investing in funds that offer low fees to make sure they retain the majority of their earnings in the marketplace.
The heart of the problem here, and it's something Vanguard and others are known for, is you got to be in the market. And the basic feeling here is things are going to fall apart in a 78, 79 pre-Volcker way. We've had to wait for that with a spectacular January.
Welcome, everybody. Let me get out of this screen. We'll get back to that in a second. Let's see. 32 people in here. Wow, I really appreciate everybody tuning in. If you could hit that like button, I'd greatly appreciate it as we can get a few more people in here. The YouTube algorithm is quite the bitch, but when this starts, there will be plenty of people in here with us. Seeing how crypto's responding right now, pretty flat, but you've seen all the markets dip, but we got the 25 basis point rate hike, which I was hoping for a 50, just nothing to do with the markets, just personal bias, because I don't want to go through hyperinflation. But if we're going 25 and then we end up printing money, well, that's exactly the route we're going to end up going. And hyperinflation is going to make it a lot worse for you and I. And if we go down that route, it's going to make it a lot more difficult in the times coming up. So I do thank everybody for tuning in. I do. I'm going to put on my phone so that I can see if there's comments, because I don't even know if you're able to comment, if I'm able to see you. And I'm almost afraid to do that because I'm afraid didn't do anything. So for whatever reason, YouTube has a very hard time showing comments. I've never been able to figure it out. So I'll just do it myself. I'll just go into the live chat. So just give me 1 sec. Crypto Scrooge, it's going very well. It's going very well. Darren, welcome in. Francisco, welcome in. Daedrox XRP, welcome in as well. I thank everybody who's tuning in. I really do. They added a new feature. I mean, I don't know if it works or not, but it says you can give subs on YouTube now. I don't know if it works or not. I don't even know if that's true, but I got an an email from YouTube saying that. Yada, yada, yada. So we got 6 minutes until Jerome Powell speaks. We got to see if he's going to be hawkish or dovish. That's why the markets haven't really moved yet. But they did announce a 25 basis point rate hike. So if I'm a betting man here, 25 basis points we baked in, so we don't have to expect like a major dump just yet. So we're going to have to see exactly how we go here. I've got the Dow's down 326 points. So after a quick recovery, the Dow came back to minus 250. Now it's back to minus 329. S&P's down 15. Nasdaq's down 6 points, or up 6.7. Barely hanging on here. We got Bitcoin up about 0.45%, hanging on to 23K right now. XRP's hanging on to 40 cents. It's been up and above and below, real quick. But we got to wait for this meeting to start in 5 minutes. That's what I'm waiting for. I'm firmly waiting for this meeting. That's what I'm waiting for. We can look at the markets. We can pay attention to all this. But the main thing that we need to pay attention to, and I'm probably just going to go to their YouTube channel, the FOMC's YouTube channel. Probably make it easier because then I can do a split screen. So I know I have them on YouTube as well. So let me... I don't want to do it through Yahoo Finance, so I'd rather just do it through the FOMC's their own website, the Federal Reserve. Here we go. So if anybody's wondering, that's the Federal Reserve's website. So I don't really want to play the music in the background because then you guys are going to have to listen to all that nonsense. So I'll turn the volume down. But that's the FOMC's website. And then if I do it like this, the cool thing about this is I can actually do this, and then we can actually look at the markets and watch this at the same time. So just use the player. So then we'll at least be able to watch the live reaction of the charts together and see what's going on. Lana, welcome in. Nick, welcome in. I appreciate that. I appreciate you tuning in. Yeah, I know everybody was looking for a quick drop. It did have a quick drop. Honestly, it did have a real quick drop if anybody was buying a quick dip. It went back sub 30 cents. I've been begging people sub 40 cents or sub 40 cents it went. Yesterday it dipped right down earlier in the week. Yesterday it came back down to about 3.9. This was this morning, the 3.96 right before the meeting, as everybody was kind of anticipating. I mean, the market anticipated the 25 basis points. This is one of those cases where you would have wished for a 50. If it would have came 50, it would have dropped the hammer on the market. Just because of the way the market was fixating on the numbers. I mean, you guys always wonder. I'm just watching the charts on the TV. I kind of got to turn them down, Bloomberg's nonsense. But they got the charts running across the side so I can see world charts and all that good stuff. So it helps you keep a basic understanding of what's going on. So XRP still in this formation. Still in this formation. We would need to break this uptrending or downtrending resistance up here at the 417. It still feels like at some point we would, no matter what, have to retest that 446, 447 level depending on where we hit it. Because it really does. It feels like that's where we would have to hit it. But who knows? We'll see. I'm not here to speculate. I'm just here to watch this unfold. And like 25 basis points is dovish. It's not hawkish. Now, if he comes out and he starts speaking hawkish, something big will happen. But as of right now, I mean, this rate hike was a joke. 25 basis point. That means, it just proves how the central banks are in control.
At the data, and
Yeah, XRP's already starting to move a little bit. It absolutely is because it was down to about 397 right before they announced 25. So it definitely can.
and I'm sorry, it could be a complete change off of jobs.
I appreciate everybody tuning in. What do we have?
No, I can't.
Let me update this because if that's all the likes we have, I'd appreciate if everybody could just hit that like button.
More proven than they need.
There is clearly a tug of war right now.
Yeah, 31 people have hit that like button, 46 watching. So I'd appreciate if you hit that like button. At least I can see the likes. 34, 46 watching. The more people that hit that like button, the more of our friends we can get in here. Because I still get messages all the time that YouTube's not notifying you. Well, all you have to do is be following my Twitter or be in the Telegram. Twitter's free. I always post when I'm going live or when my stuff comes out. Yes, it's final 25 basis points. They came out at 2 p.m. to announce that. But we're about to be shifting gears here, folks, to Jerome Powell. As you can see where the markets stand, we'll watch this live unfold. If you want, I can put it like this so we can watch on the side the markets as they unfold on us. I can put it over here and we can watch live charts as they break down. But we got the Dow and S&P up top. We got the DXY's at 101.81. So everything's relatively flat. Total crypto market cap still over the 993 billion. So, but right now we're waiting for Jerome Powell after the breaking news. The Fed only raises rates by 25 basis points. And it shows a willingness by the Fed, at least, to usher in hyperinflation, which it might seem good now if the markets pump a little bit. But I'm telling you right now, this is bad long term. If they start printing money, it's even worse. But let's shift gears here, and I'm going to shut the hell up so you can watch Jerome Powell. We'll do a little bit of questions as well. But I'll type in the comments while Jerome's speaking so I don't interrupt. So we'll see, but it's definitely a more hawkish tone. And I'm gonna go back to the website just so there's no discrepancies on YouTube.
Guess what? I'm going to go to the American philosopher Neil Dutta. It's a pretty good economy.
You saw what Neil said this morning in that message to me. Houses picking up again.
All right, well, we'll see what happens here.
The IMF. I've never seen an economist on Wall Street bring up an IMF forecast in the way.
Good afternoon and welcome. My colleagues and I understand the hardship that high inflation is causing, and we are strongly committed to bringing inflation back down to our 2% goal. Over the past year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effect of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 25 basis points. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we are continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 1%. Recent indicators point to modest growth of spending and production this quarter. Consumer spending appears to be expanding at a subdued pace, in part reflecting tighter financial conditions over the past year. Activity in the housing sector continues to weaken, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 247,000 jobs per month over the last 3 months. Although the pace of job gains has slowed over the course of the past year and nominal wage growth has shown some signs of easing, the labor market continues to be out of balance. Labor demand substantially exceeds the supply of available workers, and the labor force participation rate has changed little from a year ago. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in December, total PCE prices rose 5.0%. Excluding the volatile food and energy categories, core PCE prices rose 4.4%. The inflation data received over the past 3 months show a welcome reduction in the monthly pace of increases. And while recent developments are encouraging, we will need substantially more evidence to be confident that inflation is on a sustained downward path. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that's not grounds for complacency. Although inflation has moderated recently, it remains too high. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation.
I don't know. Based on the fact he only did 25 base points, that seems to tell me he's speaking a whole bunch of bullshit right now. If he really felt that way, he would have dropped the hammer and did 75 or 100 because we need to get this under control. Not go soft at 25.
Range for the federal funds rate by 25 basis points, bringing the target range to 4.5 to 4.75%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.5 percentage points over the past year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive.
Look at this guy shaking like a leaf, like the central banks have beat the hell out of him before he made this talk.
Effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 25 basis points today, continuing the step down from last year's rapid pace of increases. Shifting to a slower pace will better allow the committee to assess the economy's progress toward our goals, as we determine
you haven't hit any goals.
Future increases
you
that
slow
will be
played it, you
required
dummy.
to attain a sufficiently restrictive stance.
As a fucking moron.
We will continue to make our decisions meeting by meeting, taking into account the totality of incoming data and their implications for the outlook for economic activity and
This guy's
inflation.
a fucking tool.
We have been taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run.
Whoops. That's why I had it like this.
We will stay the course until the job is done. To conclude,
Look at
I
this.
understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public
The
mission.
Dow made a huge
We
bounce
at the
just
Fed
now.
will do everything we can to achieve our maximum employment and price stability goals.
Look at this.
Thank you, and I look forward to your questions.
Chris.
Holy hell. That could not... I mean, you want to talk about
Achieve
a...
our maximum employment and price stability goals.
You want to talk about a way for him to pump the markets here. That's about as soft as he could have talked right at the end. Yeah, we're going to keep going, but... I mean, there was... If you want a reason for this to turn around real quickly, I mean, it could, but that wasn't exactly something that I would be like, oh, the markets are just going to take this and run. That didn't sound great to me. As far as, like, if you're looking for a environment where this is just where he's going to pivot. He
Chris
didn't talk
Ruby,
pivot.
Associated Press.
That's
Thank
the
you for
one
doing
thing.
this.
He didn't talk pivot.
As you
So
know, financial conditions have
he
loosened
talked a little
since
bit
the
of
fall,
it,
with
but-
bond yields falling, which has also brought down mortgage rates, and the stock market posted a solid gain in January. Does that make your job of combating inflation harder? And could you see lifting rates higher than you otherwise would to offset the increase in, or to offset the easing of financial conditions?
So it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place in order to bring inflation down to 2%. And of course, financial conditions have tightened very significantly
That's
over the past year.
unbelievable.
I would say that our focus is not on short-term moves, but on sustained changes to broader financial conditions. And it is our judgment that we're not yet at a sufficiently restrictive policy stance, which is why we say that we expect ongoing hikes will be appropriate. Of course, many things affect financial conditions, not just our policy. And we will take into account overall financial conditions along with many other factors as we set policy.
Yeah, he's setting this in motion right now.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. Over the last quarter, we've seen a deceleration in prices, in wages, and a fall in consumer spending, all while the unemployment rate has been able to stay at a historic low. Does this at all change your view
Just
of how much
fucking
the
wow.
unemployment rate would need to go up, if at all, to see inflation come down to the levels you're looking for?
So I would say it is a good thing that the disinflation that we have seen so far has not come at the expense of a weaker labor market. But I would also say that disinflationary process that you now see underway is really at an early stage. What you see is really in the goods sector.
Look, what he just said, inflation's at an early stage. So that's a key. That's a key word that he just used. Like, we're early on in this inflation fight. That's what he just said. Now, if the market's picked up on this, this should return. It should reverse in the 1 minute. But that's not what you want to hear if you're looking for this to not be long term.
The inflation now coming down because supply chains have been fixed. Demand is shifting back to services, and shortages have been abated. So you see that in the housing services sector. We expect inflation to continue moving up for a while, but then to come down, assuming that new leases continue to be lower. So in those two sectors, you've got a good story. The issue is that we have a large sector called non-housing service, core non-housing services, where we don't see disinflation yet. But I would say that so far, what we see is progress, but without any weakening in labor market conditions.
Has your
Go ahead.
Has your expectation for where the unemployment rate might go changed since December?
You know, we're going to write down new forecasts at the March meeting, and we'll see at that time. I will say that it is gratifying to see the disinflationary process now getting underway, and we continue to get strong labor market data.
What a load of horse shit. I mean, come on. It's going to be a long road, folks. Just buy your gold and silver. Along with your crypto, buy your gold and silver, because you're going to need real money for this, because now the U.S. dollar is going to actually take a real... Basically, what's going on is Saudi Arabia and all the nations that are starting the BRIC nation, the whole BRICS thing, China's part of it now, and they're all buying a bunch of gold. And he's not going to tell you it, but I will. They're buying a bunch of gold because they don't want to pay for oil with the greenback, with the petrodollar. They don't want to use the U.S. dollar as the currency. So what they're doing is they're trying to prove that their native currencies, like in Saudi Arabia or in China or India, they're trying to prove that their currency is good enough. You'll start hearing about the ruble and the INR and all these other ones. And the reason why you hear about these now is because they're proving that their currency is good enough by backing it with large amounts of gold and silver. Just follow that. That's why central banks around the world are stacking gold. Because they know they're going to cause the U.S. dollar to go extinct. They're going to do it themselves. The U.S. is going to be so broke that we're going to need to use our gold and silver to get the hell possibly out of this country and go to greener pastures. And that's not a joke. But no one's going to tell you that, because not so very many people are woke. So they continue to have this mindset that everything's fine. I'm telling you right now, all of this sends you into hyperinflation, and you might as well get your shit straight right now. It's not what you want to hear, But you watch me because I tell you shit people won't tell you. That's the honest to God truth. If these BRIC nations are stacking gold, the only reason they're doing it is so that they don't have to pay for pay for oil using US dollar, the petro, the green, whatever the hell you want to call it. They don't want to use our money for petro. They don't want us to have the petrodollar. So they have to prove to these countries, or to who they're buying the oil from, hell, the Saudis, why they should accept their money. And when they prove that it's backed by gold, the Saudis love gold. They buy a shit ton of it. So if the Saudis see your backing is by gold, well, obviously they're going to say, oh, you got some reserves on hand, so your money's valuable. If you owe us money, we'll just come take your gold. When they default, that's how they're going to look at it. The U.S. don't have, once that happens, say goodbye to the U.S. dollar. And then you're going to thank your shining stars you came across me, not just for crypto and getting it cheap. And if you're doing what you're supposed to be doing, you're already supposed to have crypto already when it's down 80 to 90% in your chosen sectors. And then you have the 20% for the bottom, the true bottom that we think is coming. But who the hell knows with the way that they treat these markets?
But, we'll...
Also, hit that like button. 71 people watching, 53 likes. I'd appreciate if you hit that like. And subscribe too if you're new.
Those forecasts in March.
Neil. Hi, Chair Powell. Neil Irwin with Axios. You and some of your colleagues have emphasized the possibility that job openings could come down and that would let some of the air out of the labor market without major job losses. We saw the opposite in the December JOLTS this morning, job openings actually rising. That also has coincided with slowdown in wage inflation. Do you believe that openings are an important indicator to be studying to understand where the labor market is and where wage inflation might be heading?
So you're right about the data, of course. We've seen average hourly earnings and now the employment cost index abating a little bit, still off of their highs of 6 months ago and more, but still at levels that are fairly elevated. The job openings number in JOLTS has been quite volatile recently, and I did see that it moved back up this morning. I do think that it's probably an important indicator. The ratio, I guess, is back up to 1.9 job openings to unemployed people who are looking for work. So it's an indicator, but nonetheless, you're right. We do see wages moving down. If you look across the rest of the labor market, you still see very high payroll job creation, and quits are still at an elevated level. So by many indicators, the job market is still very strong.
Colby and then Howard. Thank you. Colby Smith with the Financial Times. Given the economic data since the December meeting, is the trajectory for the Fed funds rate in the most recent SEP still the best guidepost for the policy path forward? Or does ongoing now mean more than 2 rate rises now?
So you're right. At the December meeting, we all wrote down our best estimates of what we thought the ultimate level would be. And that's obviously back in December. And the median for that was between 5 and 5.25%. At the March meeting, we're going to update those assessments. We did not update them today. We did, however, continue to say that we believe ongoing rate hikes will be appropriate to attain a sufficiently restrictive stance of policy to bring inflation back down to 2%. We think we've covered a lot of ground, and financial conditions have certainly tightened.
Again, he's full of shit. If you really wanted to bring it down to 2%, you got to raise rates. We should be at 15% interest rate now. At least 11. This 5.25% is all horse shit. Do you realize they raised Social Security by 9%, but the real interest rate's around 15%? So congratulations, anybody who's retired or on Social Security benefits. You got a 9% increase, the largest that we've seen since the 70s, I believe it was. But you still got underpaid by 6%. So you got 9% increase in pay, but prices went up 15%, which leaves you minus 6%. But what happens? Everybody gets excited about the bottom line. Oh my God, I got $100 more a month. Yeah, but it costs you $106 more a month or $130 more a month to live. How is this a good thing? You got to raise at work and now you might make 20 instead of 17, but it costs you 22 to live instead of that 17. But you're making 20. So you feel like you made 3, but you're losing 2. Who's the real dope? Not the government. We are. We're the ones who pay for this all the time. And what do we see? Oh, hey, we could get a pump in crypto. but not understanding that in the long run with crypto, even with hyperinflation, no one's gonna have any money. So you're not gonna be able to pump. This is putting in an inverted head and shoulders possibly, like I've been talking about with the US dollar as well. This isn't done yet. And the broader markets look like they're putting in massive head and shoulders, and they've been. And this is like a big right arm that can still come up a mile and still be a massive right shoulder. Like, I think a lot of people are really in some trouble. But anyhow, I digress. That's the most emotion I'm going to show all day.
I would say we still think there's work to do there. We haven't made a decision on exactly where that will be. I think, we're going to be looking carefully at the incoming data between now and the March meeting and then the May meeting. I don't feel a lot of certainty about where that will be. It could certainly be higher than we're writing down right now. If we come to the view that we need to write down to move rates up beyond what we said in December, we would certainly do that. At the same time, if the data come in the other direction, then we'll make data dependent decisions at coming meetings, of course.
Just as a quick follow-up, how are you viewing the kind of balance of risk between those two options of, the likelihood of maybe falling short of that or going beyond that level?
I guess I would say it this way. I continue to think that it's very difficult to manage the risk of doing too little and finding out in 6 or 12 months that we actually were close but didn't get the job done, and inflation springs back and we have to go back in, and now you really do worry about expectations getting unanchored and that kind of thing. This is a very difficult risk to manage. Whereas, of course, we have no incentive and no desire to over tighten, but if we feel like we've gone too far, we can certainly, and inflation is coming down faster than we expect, then we have tools that would work on that. So I do think that in this situation where we have still the highest inflation in 40 years, the job is not fully done. As I started to mention earlier, we have a sector that represents 56% of the core inflation index where we don't see disinflation yet. So we don't see it. It's not happening yet. Inflation in core services ex housing is still running at 4% on a 6 and 12 month basis. So there's nothing happening there. In the other two sectors, representing less than 50%, you actually, I think, now have a story that is credible, that's coming together, although you don't actually see disinflation.
It's just so predictable how they trap people. It's hard.
Right?
They take the route of most fuck you over. They take the most fuck you over route all the
It
time.
would be very premature to declare
This guy
victory
never says
or
anything worth
to
a shit
think that we've
either.
really got this.
Ever.
We need to see our goal, of course, is to bring inflation down. And how do we get that done? There are many factors driving inflation in that sector, and they.
Yeah, give me one good reason, you cocksucker. I just want him to give me one good reason. Jerome, just give me one good reason. Don't tell me it's being driven or it's going to drive down itself or we're restrictive and we have to go to 2%. Tell me why. What do you see? What do you see? How about the banks get enough capital on hand? That would solve things real fucking quick if they don't have to keep borrowing money. How about that? How about that for starters? We have enough capital on hand. Oh, we can't do that because we hit the debt ceiling already. So what are we going to do? Oh, this is laying a foundation for what comes next, folks. We're going to get a nice little package here. We're going to brand it in. We have to help Ukraine. And then they're going to have stuff so we can study animals and all this other nonsense. How a penguin can lift weights for 65 minutes or whatever the hell they're going to put in this nonsense bill. All that nonsense they put in the bill that's garbage. That's just insert politician's name here and that's their paycheck for putting it in the bill. I mean, we're not studying underwater how many push-ups an eel can do. Let's face it, folks. That's just, they're putting whatever they can think of in the books. I mean, it's ridiculous what they actually put in there. But everybody buys it. And then we got to listen to this schmo. Mr. Schmoo. He's like a smurf. Look at this guy. He wouldn't know anything about the economy. He wouldn't know anything about inflation. I mean, I don't even think he knows what's actually going on. He's not even good at reading a script.
Should be coming into play to have inflation, the disinflationary process begin in that sector. But so far we don't see that. And I think until we do, we see ourselves as having a lot of work left to do.
Howard Schneider with Reuters, and thanks as usual. So I just wanted to connect a couple dots here. The statement's made a number of changes that seem to be saying things are getting better. You're saying inflation has eased. That's new. You've taken out references to the war in Ukraine as causing price increases. You've taken out references to the pandemic. You've eliminated all the reasons that you said prices were being driven higher. Yet that's not mapping to any change in how you describe policy. We still have ongoing increases to come. So I'm wondering, why is that the case? And does it have more to do with uncertainty around the outlook, or more to do with you not wanting to give a very overeager market a reason to get ahead of itself and overreact?
So I guess I would say it this way. We can now say, I think, for the first time, that the disinflationary process has
Bullshit.
started.
That's
We can see
bullshit.
it, and we see it really.
He's so you're so full of shit. Look what he just did.
This is a big sector.
Guys, he might not realize it. He might be trying to save the environment, but it's backfiring on him by the U.S. dollar tanking right now. Make no mistake about it. The faster the U.S. dollar goes down, you think it was bad going to the grocery store this morning? Wait till tomorrow when it reprices the U.S. dollar currency index if it goes and breaks 100. I'm telling you right now. If this is the end of the U.S. dollar already, get ready, tuck your head between your legs because you've already wasted too much time if you don't have your gold and silver. Right now, your U.S. dollar is losing its dollar value as we speak. Since he talked, your U.S. dollar has been deflated by 93 cents on the dollar. 93 cents. From 102, just over 102 to 101.17. That's your dollar that you have in the bank, the money that everybody wants to hold. And that's your bottom line. That's your savings. That's everything you own. It's being devalued as we speak. This schmo saying what he's saying right now. Look at your dollar. That's your pensions. That's everything right there. If you're a U.S. citizen, that dollar amount, which I don't know why it won't let me move this. Apparently now it won't let me move this. Look at this. Anyhow, but that's your future right there sinking. That's our future. And this schmo talking, look at what he's taking off the value. We go to another country and our dollar being devalued by that much right now, almost 1% across the board. The gold and silver ratio, you guys are lucky. We're all lucky. Gold's starting to pop up. It's a direct correlation with gold and silver. Crypto is not technically a direct correlation with the U.S. dollar. That's your precious metals. But let's listen to this dumb fuck.
This is what we thought would happen since the very beginning, and now here it is actually happening, and for the reasons we thought. It's supply chains, it's shortages, and it's demand revolving back towards services. So this is a good thing. But that's, around a quarter of the PCE price index.
With XRP, I've got 4,086 XRP. As you know, I had 7,200 before, so it's one of those things. You can buy more. I mean, it's only at, 41 cents right now? You can always buy more. But you just gotta pay attention to the formation. Until we actually broke up out of here and ultimately, and I'll show you, and then we'll listen to this clown so I can finish rolling my joint. I have it in my hand, but it's good, it's until we ultimately in this pattern, for me, break this 46 cents, that's where we might have to be like, you know what? Okay, if we want to add more to what we have, that might be a good spot to be adding more. Or if we come over this uptrending at 42.5, just because then it might give us the validity to come up to 446. But still, this is just standard operating procedure. And to buy more, it's always under the determination you're going to buy it when it comes lower. And right now, XRP, for all the smack everybody wants to talk about XRP, if we go back to the $1.09, there's the $1.60. So from 219%, I mean, you'd have lost all those profits. From it's still down a substantial amount. We can get the exact amount, but it's down a substantial amount from the highs in 2021. Let's look at that real quick, because then I can show you and be more honest. Like, hey, and we'll listen to this douchebag, but he's not going nowhere. We're all going to be here for a minute, and I'm going to try to answer the questions the best I can. But you can see, we're down 78% or whatever it is from the top. 79.4%. So if I told you then you can buy it for 21 cents on the dollar, and that was always the argument. So why not buy some at 21 cents on the dollar? Even if you bought everything you had, you should still have 79. So basically, if you were going to buy 10,000 shares there, if you were willing to do that, that's $19,800. Right now, those same 10,000 shares cost $4,100 approximately. So, I mean, to me, or whatever your ratio there was, how much were you going to buy at $1.98? Spend 20% of that. Spend 20% of that. That's what you're supposed to do when you're down 80%. Who cares if it's 30 cents, 41 cents, 52 cents, 18 cents? If you're down 80 fucking percent. And then if you get down sub 20 cents, like I ultimately think we're going to, and that's why I ultimately see it, why not have the other 80% or 70 or 60 that's left over by the time you get there to finish the deal? Even if you bought now, you're not going to have a 41 cent average. You're looking to buy it cheaper. Otherwise, you'd put the whole 100% in. And then if it goes up, you keep buying more. And then who knows? Maybe this is your floor. And you got some at 41 and 50 and 62 and 77. And if it goes to $6, who gives a fuck? But everybody's got it backwards. Like, I got to buy that one time under 20 cents. I've got, I've shown it in my Telegram. I got 4 or 5 different cryptos, but the amounts I bought them in at, you're talking they're down. Like XDC, I bought 10,000 shares when it was 88% down from the high a year ago. That's 12 cents on the dollar. If I would have just bought it a year ago. Now I've got 88% of my money and I've got just as many XDC as I once had. But I only spent 12% of the money that I put to the side. Like, that's what I'm talking about. And then people, oh, well, what about the 12%? What if it goes down? Good. I personally want this shit to go down. I want it to go way down, but that doesn't mean I can't start buying when it's 80% down or 85 or 90%. DGB was down to 0.0063. I bought 42,000 plus shares. Cost me a couple $100. I sold 10,000 DGB for just over $1,500. I've told the story a million times. I bought 4.2 times the amount for 7 times less. So if it ever gets back up to there again, now that same $1,500 worth is going to be worth over $6,000. And I spent 7 times less to pick it up. What the hell do I care if it goes cheaper again? I hope it does. My goal was to get 100,000. I feel like a doofus not doing it for the price it was at. But even I have the low-end hopium. But I'm not a dope. I still buy in. I still buy where I perceive it. Zill, I've told that story a million times too. I sold that in the 20-cent range. I just bought back 18,000 shares and it cost me less than what? $350? At 1.3 or 1.4? No, 1.5? Yeah, it went up to 3 and came down a little bit. I hope it goes to 0.0. The amount of money I was going to buy on Zill, I haven't even come near that. But I have 1.8 times what I sold it for. And I got it 13 times cheaper. Like, what are we doing? Everybody makes excuses, but I don't. Or what did I get it? 11 times cheaper, 12. I don't make excuses. And at the same time, I try to teach every day, but, you know, I can only do so much. You got to help yourselves too, guys. Like, let's be real. I'm doing it right in front of you. I even started a silver stacking series. What's the excuse that only got 150 views from yesterday? You know? That's not on me. That's on anybody who wants to learn. I'm trying to teach you real money for this guy. I'm trying to keep you in front of this dope. You want to use his paper money? This guy's money? Whenever you have a dollar bill on you or the $100, that's him. You ready? What happened to your dollar bill today? Look at it. Everybody who's in the dollar and has no exposure to gold or silver, you're fucked. Look at that in one day. Sure, it could recover, but wait until that's more than just that. And it's a $10 drop in one day. That's what I'm trying to get you out ahead of. Hit that like button. I don't know if anybody has. Oh, look at that, 69 and 69. I guess you don't have to. You know what, guys? I eat my words. Because when you're 69 for 69, how can I even say anything? That is too funny. Every single person watching it hit the like. I'm just going to hit my joint because I was going to sound like a real dope.
Core PCE price index. So the second sector is housing services, and that's driven by very different things. And we, as I mentioned, with housing services, we expect, and other forecasters expect, that measured inflation will continue moving up for several months, but will then come down, assuming that new lease.
Oh, and if this is reaching you well, somebody send a super thanks. Say you appreciate it. Or send me $1 and say, hey, how does this work? Just so I feel important. Pay it forward.
Continue to be soft. And we do assume that. So we think that that's sort of in the pipeline. And we actually see disinflation in the goods sector, and we see it in the pipeline for two sectors that amount to a little less than half. So this is good. And we note that when we say inflation is coming down, that this is good. We expect to see that disinflation process will be seen.
Gonna need one of these. Where the hell am I at? Oh, I'm gonna need one of those.
Ex-housing, sorry, the core services ex-housing sector that I talked about. We don't see it yet. It's 7 or 8 different kinds of services. Not all of them are the same. And, we have a sense of what's going on in each of those different subsections. Probably the biggest part of it, probably 60% of that is research would show is sensitive to slack in the economy. And so the labor market will probably be important. Some of the other ones, the labor market's not going to be important. Many other factors will drive it. In any case, we don't see disinflation in that sector yet. And I think we need to see that. It's the majority of the core PCE index, which is the thing that we think is the best predictor of headline PCE, which is our mandate. So it's not that we're neither optimistic nor pessimistic. We're just telling you that we don't see inflation moving down yet in that large sector. I think we will fairly soon, but we don't see it yet. Until we do, I think we see ourselves, we got to be honest with ourselves, we see ourselves as having perhaps more persistent inflation in that sector, which will take longer to get down. And we're just going to have to complete the job. I mean, that's what we're here for.
Nick Timmeros, the Wall Street Journal. Chair Powell, you observed several years ago that we learned we can have a low unemployment rate without above target inflation, and we have learned lately that inflation can come down from its uncomfortably high level despite a historically low unemployment rate. Given that, and given how much you did over the last year, why do you think further rate increases are needed? Why not stop here and see what transpires in the coming months before raising rates again?
So we've raised rates 4.5 percentage points, and we're talking about a couple of more rate hikes to get to that level we think is appropriately restrictive. And why do we think that's probably necessary? We think because inflation is still running very hot. We're, of course, taking into account long and variable lags, and we're thinking about that. The story we're telling about inflation is, to ourselves, and the way we understand it, is basically the 3 things that I've just gone through a couple times. And again, we don't see it affecting the services sector ex housing yet. But I mean, I think our assessment is that we're not very far from that level. We don't know that, though. We don't know that. So I think we're living in a world of significant uncertainty. I would look across the spectrum of rates and see that real rates are now positive, right, by an appropriate set of measures.
Okay, guys, would you rather have this piece of shit? Huh? Would you rather have this? You want this? You want this guy? I highly suggest instead of that guy, or this guy, instead of having $25, how about you get this, huh? Get one of these. Get a buffalo. Get 1 ounce of silver. Instead of this, you can have this. You can have this garbage. But I suggest you get some of this. Or some of this. Get some silver. Get some ounces. Get some real fucking money. Because you're going to need it. When the time's too late, I'm telling you right now, you're not going to want this shit. This isn't going to be worth dick. This. You see what happened to this? Look at today. This. What I'm holding right here just did that. Because of what he's saying. This right now might have been $20 today, but now this $20 bill just lost 1/100th of its purchasing power. It lost just about that much of it today. It lost 1 out of 102 of its purchasing power. So now instead of 102 of these, now we only have 101 out of these 20s. If you want to look at it that way. We've lost 1/100th basically of our purchasing power. Well, it's actually 1 in 100 seconds of our purchasing power in one day. That's what I'm saying. This has lost 1/100th basically of its purchasing power in one day. So, I mean, what do we think of that? Does that make it clearer? This, when the day started, my silver, look at what just happened to our dollar. Look how much of our purchasing power we lost in our dollar just now while we were watching this. Today, silver, now this is worth $24 almost. This went up 20 cents thanks to what he's saying. So the fact that I have the majority of my money in this, in gold, mostly silver, but gold and silver, instead of this junk, I don't trust this. This is paper. This shit comes out of the ground. My government gave me this. God gave me this. I'll trust God over these fools any day of the week because this dope is who's in charge.
They're positive across the yield curve. I think policy is restrictive. We're trying to make a fine judgment about how much is restrictive enough. That's all. And we're going to...
Hey, Don. Don Jackson starts off. It says celebrate the first super chat from Don Jackson, sending $1.99. Stack your silver, people. He is leading you right. Thanks a bunch, man. I appreciate that. And Darren sending $22.22 euros, which, thank you, Darren, as that's worth much more money than my US dollar at this point after the talk. So actually, you've actually done me right during this and sending me euro, because that's actually went up in value thanks to this old fool talking. So I thank you. I thank you very much. Really, I do, for the support. 77 people watching. That's got to not be right. 78. What do I know? And 75 at the like button. Wow. Let's continue listening to this guy.
You know, that's why we're slowing down to 25 basis points. We're going to be carefully watching the economy and watching inflation and watching the progress of the disinflationary process.
Did you or your colleagues discuss the conditions for a pause at this meeting this week?
You'll see that the minutes will come out in 3 weeks, and we'll give you a lot of detail.
What's wrong, Jerome? They haven't printed off your paper yet, like the card? Like he's got to wait for the central bank to send him his no card? Like you have no idea what you're going to say because you don't know. He doesn't know. I should be doing his job. If you had somebody like me doing his job, this country would be in a hell of a lot better place. Because I'd tell you, hey, I can't. What do you want me to tell you? Go ask the guys in charge. I wouldn't say it like that because I don't want to be off, but I'd at least let you know that I can't say shit, but I'm going to try. But this guy's a dope.
Spent a lot of time talking about the path ahead and the state of the economy.
He only cares about that. He only cares about the stock market.
And describe all the details there, but that was the sense of the discussion, was really talking quite a bit about the path forward.
Victoria. Hi, Chair Powell. I wanted to ask about the debt ceiling. Given that we've now hit up against it, I was wondering if the U.S. goes past the X date, will the Fed do whatever the Treasury directs as it relates to making payments as the fiscal agent, or will it do its own analysis of any legal constraints?
So your question is, would we... Say your question again?
Will the Fed do what Treasury directs as it relates to making payments, or will it do its own analysis of any legal constraints?
So you're really asking about... You're asking about prioritization, in effect, is what
Yes,
you're... Okay.
yes.
So I feel like I have to say this. There's only one way forward here, and that is for Congress to raise the debt ceiling so that the United States government can pay all of its obligations when due. And any deviations from that path would be highly risky.
Wow, thank you so much, XRP Rippers. Hold on, 20 CHFs. Oh, fuck, I always forget this one. But even that has gone up against the US dollar, and I'm not even sure what it is because I always forget. I'm sure you'll send it to me, but I appreciate that. You are amazing. I wish everybody could see. Here, see? That's what I got to see. Yeah, look how nice. Oh, you know what? I'll make this better. Here's what I got to see. YouTube always has other plans for me. I would have sent silver, but I'm out of pigeons. Swiss francs, thank you so much. The Swiss francs, which has gone up significantly in value today, I might add.
The economy from the consequences of failing to act in a timely manner. In terms of our relationship with the Treasury, we are their fiscal
Hey, what
agent.
happened? Where the hell did I go?
I'm just going to leave it at that.
Are you actively doing any planning of what might happen in the event that would happen?
No.
I'm just going to leave it at that. This is a matter that's to be resolved between really...
What do you want me to say? I don't know shit.
Raise the debt ceiling.
How can I answer that? I'm a dummy.
I gather there are discussions happening, but they don't involve us. We're not...
Did you see his face?
So.
Did you see him? Like, how could you even ask me to answer that question? Like, I would know anything like that. Like...
We're the fiscal agent.
Gina and Misty.
Oh my God.
Gina Smiley from the New York Times. Thanks for taking our questions. I'm wondering, was there any discussion today of the possibility of pausing rate increases and then restarting them? Lori Logan from the Federal Reserve Bank of Dallas seemed to suggest that that would be a possibility in a recent speech, and I wonder if that view is broadly shared on the committee.
So, the committee, obviously, did not see this as a time to pause. We judged that the appropriate, thing to do at this meeting was to raise the federal funds rate by 25 basis points.
You might as well
We
pause. You
continue
just
to
kicked our
anticipate
economy in the
ongoing
dick.
increases
Oh, where's my
in the
joint?
target range
This
will be
guy's really
appropriate
pissing
in order
me
to
off.
attain that stance of sufficiently restrictive monetary policy that will bring in.
So sorry to pause you, but I'll let you watch this in a sec. I thank everybody. We're not going nowhere yet. I can't believe there's still 69 people watching my shenanigans, but I'm going to relax. I'm going to smoke and toke one with you guys. So to cannabis, to the power of healing, and to God's medicine, just like God's money. Remember, I'm not going to go into the blah, 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 and the blah, 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 but there's God's money and God's medicine. Stay herbal, stay natural, stay with the earth. It'll leave you into wealth and good health. Just remember that, wealth and good health.
Down to 2%. So that's the judgment that we made. We're gonna write down new forecasts in March, and we'll certainly be looking at the incoming data as everyone else will.
Sorry, I should have been clear. I mean, would it be possible to take a meeting off, for example,
No.
and then resume?
No.
Could you, rather than just
Don't even ask him that. Don't put that in his brain.
go a little bit more slowly, take some gaps in between moves?
I mean, I think this is not something that the committee is thinking about or exploring in any kind of detail. In principle, though, we used to do was go every other meeting. If you remember, 25 basis points.
Holy shit, I'm rich. 1 Swiss franc is €1. Man, you guys really gained on the US dollar. I'm glad you did. Thank you so much for sending it and not the US dollar. I appreciate it. And a currency that is still sustainable, of somewhat worth of shit right now. I'm telling you, your currency is going to go up dramatically in the next coming years against the dollar. You're going to be very happy.
So that was considered a fast pace. So I think a lot of options are available. And you saw what the Bank of Canada did, and they left it that they're willing to raise rates after pausing. But this is not something that the Federal Labor Market Committee is on the point of deciding right now.
Steve Leisman, CNBC. Mr. Chairman, the SEP has the PCE inflation rate in 2023 at 3.1%. Meanwhile, the 3-month annualized PCE is 2.1%, and you've achieved this without going to your 5.1% funds rate, which is what you have penciled in for this year. And you've also achieved it without the 1 percentage point increase in the unemployment rate, which you have penciled in for this year. I'm wondering if you've considered the idea of whether or not your understanding of the inflation dynamic may be wrong, and it's possible to achieve these things without raising rates that high, and also without the surge in unemployment. And specifically, I wonder if you might comment on the speech given by Vice Chair Lael Brainerd, who said, to the extent that inputs other than wages may be responsible in part for important price increases for some non-housing services, an unwinding of these factors. In other words, it may not be wages, the idea that it may not require unemployment rising to get this sector of inflation.
Right on, Daedrox. Right on.
So a couple things. First, on the forecast.
This fucking guy's so stupid. Like, what are you going to tell this? He can't even answer this. What is he going to...
3-month, say, measures of
drives me up a wall.
PCE, core PCE inflation. They're quite low right now, but that's because it's driven by, significantly negative readings from goods inflation.
Oh, you mean the goods that we have to buy to live on? I hate when they say strip food and energy. Okay, well, let me ask you a question. Does anybody you know who lives without food and energy? Nobody. Nobody lives without food, so you can't just strip it. When they say strip food and energy, no. How about we strip the government budget? How about we strip these endless handouts? That's something we can live without. But you can't live without food and energy. And I hate when they say, well, if we just minus food and energy, if we strip this part of it with the... He just said, with a part of it you can't strip out because we can't live without it. It makes no sense. It really doesn't.
Most forecasters would think that the significantly negative readings will be transitory, and that goods inflation will move up fairly soon back.
It is. The euro's just as bad because it's controlled by the central banks as well, which is who actually runs the world. If you guys know, if you watch me long enough, but and gals. But that's true, but the US dollar is going to fall at a faster clip. So it's going to make your money look better in comparison. Although yours is going to fall with it, we're going to be one of the big dominoes to fall. The euro's already had that fall. And now it's looking worse because of what the US dollar has done. I promise you. I promise you. This is all set up for a reason. And when the US dollar goes away, it's going to be the countries who have gold backing their reserve currencies. Or as a citizen, ready? Why I buy XRP and the ISO coins and the Internet of Things coins, tokens. Because when it comes down to it, you're going to need a speculative currency as well. And to me, crypto is the one that makes you all the money. I don't buy mining stocks like I used to because now that used to be my currency. Like, oh, this is how I can up it through the mining stocks. I see crypto as a far more valuable asset than mining stocks now. That's why I don't talk about them as much. Unless you want a dividend paying one, because that's equivalent. If you find the right cryptocurrency, if you find one that's transcending things, and that's why I think XRP is so important. It's not just the cross-border payments. They all have cross-border payments. That's the horseshit. Swift is a cross-border payment. That's the stupid thing. When I see people come out and be like, oh, it's a cross-border payment. Thanks for showing me that you don't know anything about XRP when you're giving me content and a reason to buy. How about its liquidity? That's it. That's all I want. That's all I care. RippleNet, the ODL, and their liquidity is what you should tell somebody. That's it. That's all they need to know. The centralized, decentralized is speculative because of the group of people that actually own it. They could make it not centralized, even though its intention is to be centralized, even though it has nodes that, all this other nonsense. But I'm just saying, from a base feature, XRP is what we need to have for our funds to grow so much. The gold and silvers maintain our store of value. We can't get it twisted thinking crypto is a store of value. Crypto is a speculative fund because it doesn't pay dividends, but just because it doesn't pay dividends, like in yesteryear with Bitcoin, XRP is that early still. When Bitcoin was $100 and $600, no, it wasn't 6 cents. But do you really care if it was $100 or $400 now that it's 23,000? No. Do you really care if XRP was 1/10 of a penny, 40 cents, if it was $160? You see what I'm saying? No, you don't give a fuck if it was 40 cents, 0.8 of a cent, 72 cents, $2. You just know you made a ton of money. Well, $2 is too high, but you get what I'm saying. That's why sub 40 cents, especially even sub 52 cents has always been a great deal. Under $1, anything that you could double getting to $1 is a good deal. There you go. Anything you can double on XRP getting to $1 is a good deal. Because then from $1 to $10, that's a 20x. What's it from 10 to 100? Yeah, that's a 10x. But what is it for you from 50 cents? That's what I'm talking about. That's why these prices where you can get it where it's at, people are getting so crazy in their head over, I don't have it at 20 cents yet. You don't need it at 20 cents. You don't.
Up to its longer run trend of something around 0, something like that. So a lot of forecasts would call for core PCE to go back up to 4% by the middle of the year, for example. So that's really where the sustainable level is more like at 4%. So that would suggest there's
Thank you for the 9 months, XRP Rippers. I really appreciate that.
work left to do. Let's say inflation does come down much faster than we expect, which is possible. As I mentioned, obviously our policy is data dependent. We would take that into account. In terms of the core non-housing services, as I mentioned earlier, it's a very diverse sector, 6 or 7 sectors, and so sectors that represent 55 or 60% of that subsectors of that sector we think are sensitive to slack in the economy, sensitive to the labor market in a way. But some of the other sectors are not. And for example, financial services is a big sector that's really not driven by labor markets, wages. So that's why I said there are a number of things that will affect. Take restaurants, right? So clearly labor is important for restaurants, but so are food prices. And transportation services is going to be driven by fuel prices, for example. So there are lots of things in that mix that will drive inflation. I would say overall, though.
Hey Jan, welcome in. I appreciate you tuning in.
My own view would be that you're not going to have a sustainable return to 2% inflation in that sector without a better balance in the labor market. And I don't know what that will require in terms of increased unemployment, your question. I do think there are a number of dimensions through which the labor market can soften. And so far, we've got, as I mentioned, in goods, we have inflation moving down without the softening in the labor market. I think most forecasters would say that that unemployment will probably rise a bit from here, but I continue to think that there's a path to getting inflation back down to 2% without a really significant economic decline or a significant increase in unemployment. And that's because the setting we're in is quite different. The inflation that we originally got was very much a collision between very strong demand and hard supply constraints, not something that you really have seen in prior business cycles. And so,
wow, thank you so much. 70 people in here, but 81 likes. I really appreciate it. Even the people that were coming in were hitting the like button. Like, you don't know how much that means to me. That's unbelievable.
now we see goods inflation coming down for the reasons we thought, and we understand why housing inflation will come down, and I think a story will emerge on the non-housing services sector soon enough. But I think there's
the mining stocks,
and we don't yet see.
Look at the mining stocks that I always talk about if you want to get a dividend-paying ones, the ones that I have up here. This is what I'm talking about, hedge against, when the dollar does stuff like this. If the gold and silver is going up, these are kind of like, so if Bitcoin's going up and you own gold and silver and you want mining stocks, this is like your Bitcoin with the altcoins. That's the mining stocks for gold and silver.
We don't yet see weakening in the labor market, so we'll have to see.
Can we get there with 5%?
Certainly possible. Yeah, absolutely, it's possible. It's a question no one really knows. I think it's because this is not like the other business cycles in so many ways. It may well be that that it will take more slowing than we expect, than I expect, to get inflation down to 2%. But I don't. That's not my base case. My base case is that the economy can.
And for the same reason I told you, stay away from crude oil for a hedge against inflation. It's good to own, but you can't use that as your hedge. That's gold and silver. Don't get it twisted. Everybody always tries to talk about oil. There's reasons why it's too connected to the U.S. dollar, why you can't do it.
Return to 2% inflation without a really significant downturn or a really big increase in unemployment. I think that's a possible outcome.
Oh my God!
I think many forecasters would say it's not the most likely outcome, but I would say there's a chance of it.
Michael McKee from Bloomberg TV and Radio. I'd like to pick up on what you were just saying about a substantial downturn and ask, with the full weight of your tightening not in place yet, and with the progress against inflation, there's still a lot of talk about very, very slow growth going forward in 2023. And the recession indicators are all suggesting that we are going to see recession this year. So I'm wondering if you've changed your view, or you have a more nuanced view of what you think the danger to economic growth is going forward, and whether you're very close to perhaps tipping it into the wrong place, which calls for more restraint on your part.
So I do think most forecasts and my own assessment would be that growth will continue, positive growth will continue, but at a subdued pace, as it did last year. We had growth of GDP growth of 1% last year, and also final sales growth, which we think is a better indicator of about 1%. I think most forecasts and certainly my assessment would be that growth will continue at a fairly.
He is so full of crap. I so agree, Axel. But yeah, Jan, he's such fibs. Axel, welcome in, by the way. Appreciate having you here after all this time. You're one of the early viewers from early on when I had I don't even know, nobody. XRP Rippers, 9 out of 10 francs are backed by gold at the Swiss banks, and 1 franc has the population. Damn. There you go. I'm glad you sent me some francs, buddy. At least that has some hope.
Subdued level this year. There are other factors, though, that need to be considered. You will have seen that the global picture is improving a bit, and that will matter for us potentially. The labor market remains very, very strong, and that's job creation, that's wages. As inflation does come.
Real quick, they always tell me to prove that the gold vault is empty, because I always say we don't have any gold at the gold vault. You want to know how I know we don't have any gold? You want your proof? We're printing money. We're printing money. If we had gold in the gold vaults, we wouldn't be afraid to, I don't know, use a little bit of gold to pay off our debts because that's what it's there for. So we don't, right? But instead, if we really had gold, that we wouldn't want to devalue the price of our own gold by being in the vault. The only reason it's being artificially suppressed is because we don't have any. And the more expensive it gets, the less likely someone's going to have to own a dollar. Imagine if $1 could, or an ounce of gold that costs 6,000 US dollars to buy. Now people are going to be pissed. It costs $200 an ounce of silver. People are really going to be mad because they're going to be like, wait a minute, that's kind of expensive. But that's only because it's not, the gold and silver didn't change its value, guys and gals. Our money just is going to shit. So right now, gold today is worth $19.47. That same gold and the silver's almost up to, it's at $23.97. That silver bar didn't gain 1.12% in value. Gold didn't gain 1%. Our money just lost 0.98%. There's your direct correlation.
Down, sentiment will improve. You also, state and local governments are really flush these days with money, and many of them are considering tax cuts or even sending checks. So I think that's going to support. They're also spending a lot. There's a lot of spending coming in the construction pipeline, both private and public, and so that's going to support economic activity. So I think there's a good chance that those factors will help support positive growth this year. And that's my base case is that there will be positive growth this year.
Rich?
Thank you. Rich Miller from Bloomberg. First of all, how are you doing?
Fine, thanks. Fine.
Good. Second off, I think earlier on in the press conference, you said you need to see substantially more evidence of inflation coming down. Can you give us some idea of what you're thinking of? You mentioned 3 months, that we've seen 3 months in a row. Governor Waller suggested he might want to see 6 months. Is it just the inflation data, or do you have to see the labor market coming back into better balance to have that substantially more evidence?
So I don't think there's going to be a light switch flipped or anything like that. I think it's just an accumulation of evidence. So of course we'll be looking, by the time of the March meeting, we'll have 2 more employment reports, 2 more CPI reports, and we'll be looking at those carefully, as all of us will, and we'll be asking ourselves, what are they telling us? And soon after that, we'll have another ECI wage report, which, as you know, is a report that we like because it adjusts for composition and it's very complete. And the one we got, I guess it was yesterday, was constructive. It shows wages coming down, but still at a high level. They're still at a level that's well above where they were before the pandemic. So I don't want to put a number on it in terms of months, but as the accumulated evidence comes in, it's going to be reflected in our assessment of the outlook, and that will be reflected in our policy over time. But I will say, though, it is our job to restore price stability and achieve 2% inflation for the benefit of the American public. We're not, market participants have a very different job. And it's a fine job. It's a great job. I did that job for years, but in one form or another. But, we have to deliver that. And so we are strongly resolved that we will, complete this task because we think it has benefits that will, support economic activity and benefit the public for many, many years.
Hey.
Thank you, Michelle. Thank you, Fed Chairman, for taking the questions. So you've talked about we had solid job growth. I'm Edward Lawrence from Fox Business, by the way. We had solid job growth, a slight falling in the increase in consumer spending. It seems so far it's been relatively mild from the economy to go from a 9.1% CPI inflation to 6.5% CPI inflation. Is the hard part yet to come to go from 6.5 to 2?
I don't think we know, honestly. So we, of course, expected goods inflation to start coming down by the end of 2021.
All right, yeah. So, Jan, to answer your question, I do. It looks like they're going to draw this to hyperinflation route, and if they do that, but the problem with this is look what I really don't think they intended on the dollar to crash that hard. I really don't. Because if the dollar sinks and tanks, they can print all the money they want. We don't have any money. We don't have any money. So if it does tank this fast, that's a big blow to the dollar right there. That's a big blow to the dollar. And this is the scenario we talked about, that we don't want this to happen. This doesn't mean crypto pumps. It just means that everything's going to hit it even harder. I mean, crypto will pump some, because if the dollar is being deflated. But if other things are happening in the regulatory framework, it's making it very scary out there, because right now crypto is supposed to be somewhat of a safe haven, but what's happening? It's been going down with the dollar. So let's see how crypto reacts here, because you would think somewhere crypto is going to have to pop up a little bit. But that's the drawing that I made now. That's our hope. If it's doing something like that and creating an inverted head and shoulders, anything outside of that, we could be in some trouble here, especially if we lose that downtrending support. This pattern's not done by a long shot. We still have to break below the 100 spot about 32. But if we do, we're in some serious shit. I'm done listening to Jerome, though. He's talked out his ass this whole time. You can't listen to a word he says. I got to go, though, because kids are getting out of school. But that's what I got for you. Any last questions? And I'll let you go. I appreciate everybody tuning in for all of this. I really do. Yeah, thanks, Jerome, you piece of garbage. That's the thing. Exactly, Axel. More people are going to be putting money eventually into gold, but they should also... you should be putting your money in silver. It's that... I'm just being honest. You need to put your money in silver. If you're doing it right now, unless you have a bunch of money, the silver ratio is 81, or gold silver ratio is 81-1-8. If you want gold, you just trade some silver when the ratio comes down to 40 or 1 or lower. It's gonna happen. So that's just my opinion. I'm XRP Future Millionaire. I appreciate everybody who sent a donation. Hopefully somebody who's watching consider joining Tom's Army, or hit that subscribe button and share this far and wide so we can get more people into the community. I really appreciate everybody. Darren, I appreciate it. Crypto Scrooge, Axel, Jan, thank you so much. XRP Rippers, I appreciate it. And I appreciate you being 9 months. I appreciate the 20 from XRP Rippers, 2222 from Darren Rippers, $1.99 from Don Jackson. I really do appreciate it, everybody. Thank you so much. And until next time, I'll see you in an update to come later tonight.
How you doing?